After all, you're technically low income in SF, where you have your programming job. With all those student loans and skyrocketing house prices, even if you have $100,000 salary, it doesn't feel like enough to ever make it. After all, you're technically low income in SF, where you have your programming job. So you've been working from home, and over time you got very efficient at doing your job. On one hand, you could work harder, but what's the point? You can't really get a promotion for 2 more years. So what you end up doing is mostly browsing Reddit and playing video games after you finish your work for the day, which only takes you a few hours. That is until you stumble upon a website called overemployed.com. Turns out there's a massive group of people, mostly programmers, working multiple jobs at the same time, with some working up to 5 jobs at once, earning over $1 million a year.
So yes, I had 2 full-time remote 6-figure positions at the same time. They didn't know about each other, and it completely changed my life.
This, Overemployed says, is the real door to financial freedom. Freeing yourself from layoffs and office politics, improving your mental health, and even looking forward to that day where you get fired and you get a severance package. But why are these people mostly programmers? Well, it's not just because a lot of programming jobs were remote even before COVID, but you also get uniquely good compensation, and programming environments, especially agile ones, they're results oriented, meaning you don't have to clock in and clock out as long as you get your work done. So we're gonna dive into the dark arts of being overemployed, how people are pulling this off with a 5-step plan and pushing the limits of what's possible with up to 5 jobs. By the end, you'll be able to decide if this is a justifiable symptom of a broken system, or you'll have the moral high ground to judge these reprehensible individuals. This is how to become overemployed. Just 8% of tech workers are feeling confident in their job, and 92% are insecure, said the CEO of the company Blind. And more than 32,000 people have been laid off from the tech industry this year, according to TechCrunch. Companies are looking out for their own survival, and the casualty is often people's livelihood, and no one is going to do that for you as the individual. So to take things into your own hands and become financially free, you decide to become overemployed. Here's a 5-step plan to do that. Now, to be clear, I don't endorse doing this or think it's ethical, and we're going to come full circle by the end. Step 1 is overcoming the barriers, both practical and ethical. Carl Janssen on Quora wrote, "I don't understand how it would be possible to have 2 jobs." He points out that what if your 2 companies schedule a conflicting meeting? Well, Overemployed's got your back because they have a cheat sheet of meeting excuses, how to reschedule, and even how to join 2 at the same time. One of the excuses rated very effective is saying you're putting down your head to work more. It can even work in your favor and get your reputation as someone who doesn't like to waste time. As for joining 2 meetings at once, well, one technique is to wear a headphone in each ear and then mute microphones back and forth when you, for example, hear your name. Other workers have gotten more creative and used virtual assistants who send them a message when they need to reply in one chat or the other. Skeptics also say, can you really keep up the facade of working 4 hours a day when everyone else is working 8? Well, you have to be okay with being below average at one of your jobs and the very real possibility of getting fired at any time. But for a lot of companies, a low productivity engineer, given the difficulty to find one, is better than having no engineer at all, but we'll come back to that. Okay, let's move on to step 2, because not every job is going to be good for overemployment. In fact, some companies are going to find out very quickly, and those are the ones you want to avoid. Anytime you get a red flag of micromanagement, that's when you want to back off and maybe not go for that one. The consensus is contractor jobs are better because they pay you higher cash, and usually equity is not going to pay for a period of time. So if you do end up getting fired, you want to get as much as possible up front. Now, here's where it gets interesting. Even if you're a medium or senior skill level, you want to go for jobs that are punching below your weight. And the reason is people want to think you're less skilled than you actually are, so you can be more productive with less time. It's very tempting to go for 2 extremely high-paying jobs, but it's better to have 2 or even 3 jobs that pay slightly less, because when you add them together, you're still going to make more salary. In other words, adding 2 junior positions together is going to be higher than 1 senior position. You can join and the expectations are going to be lower, so you can work below your maximum output from day 1. Interestingly, when getting that second job, some fall into it by chance. An anonymous software engineer told the Economic Times that he was interviewing for jobs and got 2 different remote offers. So instead of turning one down, he just said, hey, let's give this a try. And he's been working for 2 non-conflicting Silicon Valley companies ever since, but the thought of termination does keep him up at night. Now for step 3, the legal implications. According to Richard Greenberg, New York City employment lawyer, working 2 jobs is not illegal by default. Well, at least it's not criminal. That is, unless you sign an NDA and end up sharing code, or if you sign a non-compete and you work for 2 competing companies. This same attorney also said you would have to be pretty dumb to get caught. So realistically, the worst that's probably going to happen is you get fired, which is the next step, which is creating a risk-reward trade-off in your head. In other words, thinking what is the worst that's going to happen.
So I got caught. I tried to work 2 full-time jobs at the same time, and they found out.
Yes, people do get caught, but sometimes can even frame it as a positive. According to Jérôme Coquier on Quora, there's so many companies out there you can just burn bridges and cut ties even if the worst case scenario happens. It's most interesting here to return to that guy who is earning 1.3 million a year with more than 5 jobs. What he said is you just have to be super confident and protect your time. Then if you do get caught, you just don't have to care at all. If you never stop interviewing, you can go into each job expecting to get fired. Then the ones that really don't notice if you don't do work, those are the ones you'll be left with at the end. Just keep it moving. Now, while this guy seems extremely naturally stress tolerant, not all of us are. So step number 5 is dealing with the stress on an ongoing basis. And this one's not going to be so positive, so you might want to turn off the video now if you're thinking of doing this seriously. One Temple University student had a bitter experience saying, please don't try this. You will fail. As I tried working 2 jobs remotely, and despite being in different time zones, the stand-up meetings, that is the daily meetings, were at the same time. Needless to say, it raised my anxiety levels and made me look like a fool. Now I quit one of the jobs and I feel much better because the day you could get caught could be any day. But imagine this, what if your company found out and they actually didn't care? Or what if you told them?
So for the past 6 or 7 months, my manager knew that I was working full-time for another company and still let me keep my job working for him.
A YouTuber, Random Tech Thoughts, said, just inform your employer. Stress is going to eat you alive if you don't. And they might need you enough where it would be okay. I mean, think about how many people a manager has to interview to hire someone, and they also have to pay for those jobs. A recruiter's probably getting paid, and maybe even a recruitment agency too. And keep in mind, most people in the company don't want to do more work, just like you. But if we think too long down that thread, it can bring us to a sobering realization. The people on the other side of this raw deal are people too. And chances are your engineering manager was at one point just like you and is not an evil corporate overlord. Engineering manager Chris Hansen hired a new programmer and noticed he was acting strange, missing meetings without excuses. He soon found out this person had not left their previous job. So how did this manager play the situation? Well, he was extremely angry, but he didn't actually say anything because, in his words, it would have been like cutting his own arm off. Better to have someone than no one. And you got to feel bad for this engineering manager or any product managers too, because if you get one or more of these people on your team, well, your projects are not going to get completed. Not to mention the most innovative companies of our time, things that improve our life like Airbnb, while they didn't get to where they were by having a lot of people who were just trying not to get fired. There could also be a situation where the other programmers on your team have to pick up your slack, and the resentment is definitely going to grow over time if they're pulling more weight than you are, especially on the same salary. While the overemployed movement is definitely an interesting case study, the reasons for it affecting the people around you, affecting a company who's giving you a shot and is trusting you to deliver more value than they're paying you, as well as not just living your life trying to squeeze out value, but creating a body of work and career that you can look back on and be proud of. Now that could be important to you too, or this could all be overshadowed by the fact that getting to financial freedom can lead you to the life you actually want to be living, even if you got to step on some toes on the way. So what do you think? Is it justified or not? Let me know your reasons in a comment. I'm sure there will be some arguments down there, and I hope you enjoyed this peek into the world of the overemployed. I'll see you next time for more tech stories.
Hello everybody and welcome back. So in this video I'm going to be sharing with you my tips, tricks, and advice to getting better at solving problems. Now in my opinion, problem solving is one of the most important skills that you can have, especially as a programmer. The ability to look at a complex topic, question, problem, whatever it may be, and break that down into smaller components that you then solve is something that's really important. And in fact, a lot of people know this. Look at the big tech companies like Amazon, Facebook, Google. The number one thing that they evaluate you on when they bring you in for a technical coding interview is your ability to problem solve. I can speak firsthand that during my coding interview, there was some situations where I didn't even have to write much code because by the time I had got done solving the problem on the board, talking about my solution, and kind of walking through how I was about to code it, the interview was already satisfied that, I had come up with the solution. They had seen me code previously and they were like, hey, you know what, don't worry about it. You can skip this section. You don't even need to code that out. So as much as it is very important to know your tools and know the language, that's what they really are. A programming language, in my mind, is a tool, and you need to be good at problem solving to be able to use that tool effectively to solve problems, right? And that's what, in my opinion, makes a good programmer, someone who knows their language, knows their tools well, and can apply them into a problem that they've never seen before. So in this video, what I'm going to do is pop up a question on the screen, and I'm going to show you my thought process and strategy to break this down. This is hopefully going to show you how you can approach problems you've never seen before and immediately make them a lot easier for yourself. All right, so with that being said, let's go ahead and get into the question and talk about how you can get better at solving problems. All right, so we'll get to the question in just a second, but I want to show you the platform that I'm taking this question from and what my personal recommendation is for people that are looking to get better at coding interviews or problem solving in general. So the platform I'm on right now is called Algo Expert. There's a link to it in the description as well.
Unstoppable. An enemy has been slain. Shut down. An enemy has been slain. An enemy has been slain. Unstoppable. Has destroyed a turret. Dominating. Shut down. Has been slain. Your turret has been destroyed. Double kill. Aced.
Okay,
And what
okay,
we-
okay,
we
all
think
right.
that's the best way possible to make sure that Slick
Do you
is
know what?
okay and everything
Do you know
goes
what?
away.
So
Look at this. Tyler one rigging bets because Riot doesn't care. Tyler one started betting because Riot does not care. What? What does that even mean? Rigging bet? What bets?
I mean, here, do you guys know how to bet? Let me show you. I mean, just bet on my games, and why don't we hold a chat bet? I mean, it doesn't matter. It's gonna happen. So why don't we hold a chat thing? A poll in chat. I'll tell you guys. You want me to win or lose this game? You guys chat, pull it, and then whatever chat poll is, I'll do it. I mean, it doesn't matter. Riot's not doing anything. So there's a couple NA websites. Give me a second. I can find them. But most of the websites are Chinese. You need a VPN to access them. You're not gonna go to. So a lot of them are not gonna be able to.
It's not wrong. I'm dealing with it right now.
Just go there and bet on my game. I'll just lose it on purpose for you guys if you guys all want to bet. Let's all eat then, bro. Fucking Riot's dog shit anyway. Okay, another website.
Yeah, I gotta full screen this. What?
Bet on is again. I'm not sponsored. I mean, I should get a sponsor. Again, I'm not. You can't bet on the first couple of games. It usually is about an hour and a half in. Again, everybody bet lose. I'll just play for fun. I'll just Elo rip it whenever it comes out. I mean, maybe this is the play. Maybe just like full on rig the bet so that the bet, like if Riot won't do something, maybe the betting companies themselves will do something. Might steal chat's money. They might actually, guys. By the way, you might lose all your money. They might farm your PCs for fucking whatever. Could probably get hacked, etc., etc. By the way, I don't actually know how. I created an account on what.
I just can't.
A month ago. The top right corner and said your IP is my IP. I was like, oh, they're threatening me. Oh, they want me to do something stupid, so they do something like that.
You know what? The best part about this, I'm like a React channel at the moment here. He's funny, but as a streamer, like I actually feel bad for him because you can just see it on his like he's such just a gamer. Like he just wants to game, right? The guy just literally wants to play, and he's in such a weird position, right? He's so famous. He's so like just astronomically famous in this video game that this is something that's happening to him, and he just wants to play the video game. What's up, babe? Hi. So his games are being bet on. You're interrupting content for cats. Although the cat is. Oh my god! Don't scratch.
Aw,
it's
can I
fine.
blow the whistle?
Yeah, blow the whistle. He's obviously pissed off because he can't play anymore. And I just feel bad for the guy. I don't know if they're gonna do anything about this, man. This isn't even that big of a story on Reddit. It should be a big story. What are people saying about it? He could probably get himself removed from betting sites. I guess that's true. I guess at the end of the day, you could say that, like, by him doing this, betting sites are gonna have no choice but to remove him. Because he'll just rig it and farm the reward of rigging it. Would they even care though? Because they're still getting advertising. If the enemy team has 2+ betters, they will throw and Tyler will win. If his team has 2+, there's a guaranteed loss. Only a single better makes it super hard, but sometimes winnable. It depends on how hard they throw. Tyler started off consistently manually reporting. After a month, they perma-banned a couple, and 2 week banned a couple others. Since then, they've done absolutely nothing. I don't know. What do you even do? Can you do? You need people monitoring high elo, or you need people. All right, actually, I've got the solution right here. You ready? You guys are gonna like the solution. You guys aren't gonna like the solution. I have it though. So I say you guys don't like it because I think, well, maybe some of you will like it. Maybe it'll make sense to some of you guys. But my solution is that Riot should have someone, a representative, managing each major streamer to watch dumb shit happening like this, or someone that they can contact for dumb shit happening like this, who has the power to act on dumb shit like this, as long as the streamer provides proof of what's happening. And the person that is managing who's able to manage accounts is actually competent. That's what I think should happen, because right now the way it works is that you're maybe there's so much shady shit happening. And I think that would be the best answer to the problem. Basically, the way he's responding is people are betting on his games, okay, and he got sick of it, so he told his chat to he's gonna throw games on purpose and just rig the games for himself so he gets the money. It's actually pretty smart. The thing is, I was saying that the way that this should be avoided is that if you get so big that this is a real problem for you, I feel like it's Riot's obligation to step up and preserve the integrity of their solo queue, because solo queue is what funnels people into pro play, and a big amount of marketing goes into the video game through big streamers. So yeah, we need moderators. Seriously, we need them, because right now, people can just fuck the games up, and there's no recourse towards fixing it. We need universal raffle players or replays. Really, I do care. We really need a secondary dedicated software to update the client that makes raffle players playable even from older versions of the game. See, this is how the subreddit is garbage, and that no one plays a video game in it. Think about this. Does anybody know what this person's talking about? If you try to play a replay, patch behind, 2 patches behind, 3 patches behind, it's wildly inconvenient, right? You can't check old gameplay at all. This guy's saying we need a player for our replays. We don't have one. But yeah, man, this is a summary of the subreddit. It's technically you would assume that 6 million people play League of Legends, and you would assume that a large portion of them would want their game to be better, right? But look what's uploaded. Not that, right? Right? Laprob announces that Vitality have given him permission. Who? I don't even know. Who? I don't get it. This guy's hot. That guy is extremely excited to play Nunu. He is super excited to play Nunu. Yeah, don't walk up to the wave. Sit back. Just get behind your minions. Behind them. Go. Behind them. Walk with them. Well, don't walk up to the middle, because he normally will wait. He'll get in the middle and wait for you. He'll just stand in the middle of the lane and wait. Oh, he's back. Okay, cool. So yeah.
is trying to rally early in the session today and then just fell apart at the end as they have been going on. The title of this video tonight is Full Liquidation Mode, and you're going to see the database is just puking out everything, and I expect that we will see the intermediate database do the same. I'll talk about that more here in just a minute. One thing I got into talking about today in our live trading room, I got kind of on a little rant, and there's we all know that the real estate markets are very, very weak, and mortgages are just non-existent right now, and we're seeing the 2-year print up at 412, 12.6. Now the yields just keep going up. Everybody keeps talking about something that that bonds are getting attractive. No, they aren't. I'll show you something here in a little bit, and I think we're in big trouble here with yields. With this most recent surge is really starting to break things out. We had a whole slew of central banks yesterday come out, and every one of them, from the BOE across the board, with the exception of one, the Bank of Japan, the only one to buck the trend. Everybody did a 0.50, and I think it's interesting. The Fed did the 0.75, and then we got everybody else doing 0.5. And I guess it's justified in Europe. Things are much weaker just with everything that's going on there with the Ukrainian war and everything that's being affected there. But one of the things I'm going to go through, just a couple individual stocks I want you to look at, and I want you to see what's really going on in this housing market. It's starting to get very ugly, and some of the mortgage originators are in focus, and I talked about this today, is that around 70+%, I think it might even 80, I meant to look up this number before I came live tonight, of the mortgages are being originated by non-bank entities. So things like Rocket Mortgage and Home Point, there's a slew of them. And there's a couple of the big ones. I mean, I'm going to show you something here. You would not want to be in the mortgage business right now. And I'll talk a little bit more about that in a minute. But one of the things that continues to happen, and it amazes me actually, is that we continue to get crazy good numbers out of the labor market. So claims were up week over week a little bit. They were up to 213, but the continuing claims have dropped under 1.4, 1.379. And those numbers just keep getting better. It's bizarre what's going on. And I think this is what got everybody just in this confused mode. And I think the only things that are clear is that interest rates are going up, the economy is coming apart little by little, and we have a bunch of people trying to, and I guess I'll just say it, is trying to entice a nuclear war. It appears. It's bizarre. I mean, we're all sitting here with just the lemmings sitting there waiting to see what they're going to do. I mean, it's absolutely crazy what's going on. And I think that also is affecting sentiment big time. And we talked a bit about, and I'll go through when I talk about gold tonight. Gold still is maintaining itself in spite of the Dow interest rates skyrocketing. How could that be, right? How could gold be holding up? And I think it's this geopolitical situation that we're in that there's just still a bid there. We'll talk more about that here just shortly. But I'm looking at a couple other things that were out yesterday. The yield curve got more and more inverted. Yesterday, S&P down 0.84, NASDAQ down 1.37, and the Russell down 2.26. And that's the focus. And when I saw the Russell trading down, the weakest of the group today, and that had a lot to do with some of the things I'll show you when we get into, I'll wait till the Russell when I show you these stocks. But a lot of smaller, intermediate size and small companies are financial companies, and that's where all the weakness is coming in. Semiconductors was by far one of the weakest groups out there today. Somehow Microsoft caught a bid and a couple others, but not everything goes down every day. But we're definitely seeing this whole situation where the market is just continuing to implode in sector by sector. You'll see when we go to the database. It looks like we're going to be able to get through the stream tonight pretty quickly just because of there's really nothing to talk about, right? We had all the news yesterday. There's nothing really going on here. All the central banks are done. We've got a couple minor reports coming out, but nothing's coming out. And we're coming into the final week. So on Sunday night, need to do a really good job of setting up the week next week, because that'll be the final week of the quarter as we come into the end of September, which is hard to believe, right? Months just kind of cruise by in front of us very quickly. So let's go ahead and get into the database. I'll show you all that, and then we'll get into the technicals and should be able to get done fairly quick tonight. So here we go. 2,662 sell signals on the short-term database, only 25 buy signals. We're down to 14.51. I talked about last night, there were a couple numbers. 22 was one of them. Yesterday we were up and around 24%, 25. I don't have the numbers right in front of me. But we did have this massive blowout. And I was talking about it's getting down to 12, maybe down to 8%. And that's the thing. It's already happened. And just real quick, talk about the intermediate database. The intermediate database is probably going to see liquidation. I'll just put this over on the screen here. It's at 32.57. I suspect that's going to drop into the 20s as well. So we're definitely seeing the entire thing just come apart here, and there's just nothing to hold the market up. Let me go back to the daily just for a second here. There's only one sector. We had two sells for tomorrow on a sector level. We had consumer cyclical X'd out, and so did services sector. The only thing left is energy, and I suspect it's hanging on just by a little bit here. It's starting to get weaker, and that's something I'll go through as well. We're still seeing a lot of interesting gyrations going on in energy and some other things here. So it just looks like, I just have to tell you, I'm not looking forward to this next phase of the market. I guess the reason for it, my hope was that maybe with the 20% down that we've been on the S&P, that we would be able to find, maybe get some traction, set this up, and we'd be able to make money. You have to realize that we primarily deal with long-only investment advisors, and when the markets are going down, this is just no fun, okay? Can't make money. You have weird conversations with your clients, and and there's not much you can say other than, hey, we're protecting you. We've got a fair amount of cash. We're being very careful what we own, and that's exactly what you get to do in this kind of environment. You folks that are managing your own money have some advantage being able to do some things out of the box that you can't do when you're in a regulated environment. So, but still, you're getting into treacherous waters here. I'll just make a comment that when you get to these kind of phases in the market, you can just get these rip your face off short covering rallies that last for a couple of days, and you get it wrong at the wrong time, they can take a lot of money from you. And so I'm just going to continue to tell you folks to be cautious. I know you got SQs or whatever you're doing out there, especially if you're leveraging up, just be really cautious. And we had some conversations today about maybe putting on some things that you like, maybe put covered calls on or doing some spreads on options. Not going to get into that here. I really don't cover that on this channel, but we are going to be, I'm going to get some people involved that we can actually talk a little bit of options in our live trading room, because I think it's going to be one of the strategies that you're going to probably have to be able to deploy going forward. This is just going to be, not going to be, it is the worst market from an investment standpoint that there's been for a while. And I'm just going to rant on for another minute because things are coming up that I talked about earlier today. But my comparison right now, and maybe I said this last night, I spent 4 hours on the internet today, 4 hours today on the internet, so some of this stuff blends together. But I think where we are, this could be a multi-year spread market, and whether it goes down another 20% or not, maybe the pain is just going to be not being able to make any money. There was free money for so long, now that's gone. It's just going to be one of these grinding markets. And my comparison was after the two markets, and I'll cover this on Sunday night in more detail. There's two market periods to look at would be the dot-com bust, and going from after the first quarter of 2000 all the way to 2003, there was 2 years. In the middle of all that, we had 9/11 to boot, right? So we had just all kinds of negative sentiment for years, and there was no reason. There was earnings compression, there was all kinds of stuff going on. I won't touch on a lot of stuff that was going on in that period. And the other period was, even before my time, was back in 73, 74, and into that big decline, another multi-year situation. And there's just things are just so screwed up. There's no other way to put it. But it's going to take years to fix this. We knew this was coming at some stage. And I'm anxious to get into the quarterly charts as we come into the final week of September and start talking about the setup. But a little bit of profits we had on the quarter are continue to dissipate. So there's not a lot left, let's put it that way. And a little intra-quarter rally went up to about 43.27, and that was about it. A little bit more. That's our basic features. So let's go ahead and get it going through the technicals. I think there's just a lot going on here that is going to be plaguing the markets for a while. And we got election coming up, just a whole lot of stuff. My biggest concern, I just go on for a second here. My biggest concern is also that we get in just, not that the political situation isn't already a mess, but let's say the Republicans get in control. I don't know how far they'll push things, but we could be just flip the coin on what's going on with Trump and Biden and just being attacked and impeached and all the crud. I mean, the guy doesn't even know where he is, right? So the good news is he won't feel very much pain or even understand what's going on. But the bad news is that the rest of us will. And it's just going to be a mess. And who knows, like I said, we still have this thing with Putin and everything hanging out. So now we just got a mess on our hands, folks. So hang in there. We're going to do our best as we go through all this to try to find some opportunities, whether it's short or trying to find something to own at some stage. But it's just, like I said, probably the worst time ever. So sorry for the rant. We'll go on and let's get into the technicals. All right, as I look at the S&P, we continued to kind of move lower. As I mentioned, S&P was down 0.84, NASDAQ down 1.27, and the Russell down 2.26. We're just continuing down within the grid, which is typical, like I talked to you about before, in this market grid. It's roughly 12% of the time that we break out of this range that we're in. We look at let me bring up the grid on screen so you can see it here. R1 is 37.95. We've almost printed that on the downside. S1 48. We've had a low of 69 so far. All of a sudden 37.22. S3 36.96. And I talked about this number last night, which is the Fibonacci projection number, which is 37.31. So that is in play today with an S3 move. So we're looking at 37.31 with the fib target 1 on the daily. The next target after that is, we're talking a new low from June here, going down to 35.61 and then 34.56. I'm not even going to touch on the weeklies tonight. There's no reason. It's not important. I will do all of the longer term stuff on Sunday night, quarterly, monthly, all of that. We'll get into that at that time. But that's really for Friday. That's one of the things you're going to need to be aware of, is just that range. I'm looking probably R1, S2 is a possibility. And that would, like I said, that would trigger a hit on that fib target 1 here in this pattern. That pattern came in. The first time that was generated was on the 19th of September. So we started getting these fib targets here, and there's really no hope here, because what's likely to happen if we close down at S1 or lower tomorrow, which is 37.48, and there is a little bit of a premium here on the futures, so be aware of that. These futures have a bit of a premium over the cash, so somebody was talking about the cash is leading. Now, there's just actually a premium in the futures contract right now. The carry cost that's coming in, that's causing this to look like it is. But the point is, we've got PPM1 actually at a minus 0.8 now, minus 0.47, and PPM3 is actually about to go into trend mode as well. It's at 0.19. So we just got full-blown downside at this time, and any rallies will be quickly met with more selling. There's just, like I said, nothing really to get bullish about here at all. Let's go ahead and take a look at the NASDAQ. NASDAQ, same looking configuration, only difference is the weakness. It's even weaker than the S&P. We're down 0.93, 0.65, and 0.29. So all three are below 0.25 or lower, minus. These are negative numbers. All three of the trend levels are in trend mode to the downside. So they said the fib target on the NASDAQ is 11,167. So that's your first target to watch out for. And that's really the only thing that should be looking for, at least a target there. Maybe we can find some kind of magical bounce there, but there's really nothing there. These Fibonacci numbers, for all practical purposes, they're just numbers, okay? And I've said this for a lot of years, is the market will tell you where the numbers actually are. Meaning this is that if you get big reversal, outside reversal, some kind of other confirmation that something happened at a price level, that's when you know that these fib numbers are working. If you get basically a dead cat bounce, you don't get much off of a bounce off of these numbers, then they're probably going to continue down. Especially, the beauty is with the PPMs, if you have the indicators, you can see these things actually accelerating. You put this on maybe an hourly graph or something like that, you're going to get a little finer tune. Plus, maybe you'll have a better shot at picking up a reversal pattern. But not sure why it would come in, other than maybe some short covering. Just know also, as we come into next week, while I'm sitting here looking at the NASDAQ, is that next week we're going to be getting into that quarterly rebalancing mode. So there's going to be some cross currents in there as well. I'll do my best to try to figure that out. That's part of what I'll be working on this weekend, just trying to see what the setup is on for the week as we come into this end of the quarter. And so it's going to be tricky for sure, but we'll set it up the best we can on Sunday night. Next, we'll look at Russell. Russell has definitely get even weaker, minus 0.9, 0.64 on PPM2 and 0.22. So it's just about like, it actually is mimicking more of the weakness in the NASDAQ. And we are getting a little bit of volatility expansion here, meaning that the market grid is starting to blow up a little bit. Let me just bring this up so you can see this just a touch. You'll see that we're starting to get that to blow up. S1, 17.13, the low 24 so far. So I'm looking kind of S2, R1 on the downside. it looks like we're going to follow through. I'm not sure anyone's going to want to be long this stuff. Anything's, like I said, as we come into this final week, when will the rebalancing start? Will be a positive. What's going to be the scenario that plays out? Like I said, hopefully we'll be able to figure out something, maybe off of Friday's action or somewhere like that, that we'll be able to get a little better feel for that. All right, into the interest rates. A lot here. Before I do that, I already put it up there. I promised you something. I just want to show you, when I did the Russell, I just remembered, it's kind of off script, but I want to show you something here. And these two charts here, the left-hand side is Finance Company of America, Finance of America companies, and then on the right-hand side is Rocket. And look at, these are monthly charts, but you can see I've got the cursor on 21, and it is straight down. And this carnage actually started. The carnage in the mortgage market has been around. We've seen these shifts happening in the mortgage market. There's been still some hot markets, but they're starting to cool very fast. Inventory builds. I think one of the things I didn't go in depth with, I'll talk about next year in the interest rates. But I think I kind of identified something in the live room today that I'll share with you tonight, that I think there's some really big numbers coming out in the mortgage market and in interest rates in general. And it's starting to get at that point where things will start to accelerate. But this ties together, so this is probably a good point to bring this in, because this is really interest rate related, but it's also Russell, because a lot of these kind of companies are what's in the Russell. And so let's go ahead and go into the interest rates, and I'll show you exactly what I'm talking about there. So we did, by the way, get an RXT sell signal, and let me clarify that, because there seems to be, I talk about these, it doesn't mean it's a sell signal, but it just means we go sideways for a day or two. Maybe a bias to the downside. Sometimes it will actually be at the top of a sequence. You never know until they happen, but it definitely suggests we're going to go sideways. But if we look at sideways, right now 368 is S1 for tomorrow, 364 is S2, and we went out yesterday at a crazy number, we're going to call it 371, and I'm going to bring up the weekly chart, because that's that number I've been talking about, and we still have, just from a Fibonacci standpoint, we still have a target at 378. I've been talking about that all week, and look at the acceleration here on the weekly. I mean, this is pretty insane here. And what I'm going to suggest here, I'm going to draw in something here fairly quick, because this is what, when we were in the live room today, this was kind of coming up here, where this pattern that we're in here, this is potentially, I'm just doing a big swing. This is potentially a big swing like this that's about to unfold, and we're looking at 4.5%, 5.5% on the 10-year. That's going to throw mortgage rates well into 6.5%, 7%. This is, and look at these PPMs here. I just draw some arrows on them. All of these, I've been talking about this thing right here. I'm going to draw in a couple things, but this 200. This is weekly. 200-week moving average is starting to turn up. And what that's telling us, when that starts to rise, and we're looking at all of these angle of attack, this is just in this trajectory for yields just to continue up. And the PPMs are, at the moment, the PPMs are accelerating. They're not indicating the top. So a lot of folks are talking about the bond market starting with the corrective. No, it's not. And I've been talking about this for a number of years, and I should go on an old report I did, and I should go look it up. I will over the weekend, as it was even 2015, 2016. I was talking about some of the potential debt crisis situations that happened. I did that 5-7 years ago, but this thing just has been able to extend itself more than anyone has ever imagined that it could. And so we're getting at the phase, and we're starting to see some auctions, Treasury auctions, that aren't going very well. The coverage isn't as good as it was. Usually it's 3-to-1 plus. The tail is 1 or 2 basis points. We are, and I've said this, like I said, for probably 7 years, but we're closer now than ever to one really bad auction away from a disaster. So what happens? I'm going to throw out, and this is not fear-mongering, it's thinking ahead, and that's something we talk about in the live room all the time, is anticipating something before it happens. And what if this is right? Maybe even if there's something even bigger, what I have on the screen here, and that what happens is there is a bad auction, and then the bond vigilantes and other folks start to go, wait a minute, is the U.S. going to be able to finance their debt? Because that's been the thing, right? We've got the dollar world currency status. We've got all these things working for us, and that's what's allowed them to get away with this robbery and this financing of this debt like this. And what if that party ends? What happens? And you could see some really crazy rates. You have to remember, I've been through the battles of back in the day, and going back to 1979 through 81, when saw Fed funds actually at 16 and a half, and then they had, in the discount window, they put a 4% penalty on there. So if you went and borrowed money too often from the discount window and you're trying to square your books up on the bank, they charge you an extra 4% penalty. And they were trying to, it was crazy. This is all Volcker days. And then something else they did was they changed the reserve requirements on the banks, and that just squeezed us. That was the spike up to roughly 21% for a moment. It didn't, and that was with these penalties that I'm talking about. So when, I'm not proposing that's going to happen, but if they start to lose control, I mentioned yesterday and talking about the Fed in the live stream, is the Fed has no clue where rates are going to be a year from now. The dot plots are a joke. Last year, the dot plots looking out at this same 1 year out, that nobody had any interest rates over 1%. Not one Fed member at all. So let's face it, these guys don't have a clue. And market forces, for a long time, they got away with the tail wagging the dog. And now I've talked about this off and on, kind of on a little rant here, but I think it's worth discussing, is we're now back to the dog wagging the tail. So the market is controlling what's going on and what the Fed's going to do. So when Powell is talking about being driven by the data is the market, and the markets they're telling them what's going on with these rates. Like basically the market's saying with the 2 years bringing up to 4.12, why didn't you just move the Fed funds to 4% yesterday? Excuse me. That's exactly what they should have done. And the result of that is the market's going, okay, we know where they're supposed to be, the markets are going. And like I said, I'm kind of setting up a scenario where things get a little bit out of control, comes to maybe a potential, and it doesn't have to happen, by the way. The way markets work, they only have to perceive that will happen, and the markets will go to crazy spikes and all kinds of different configurations, just on the basis that the market sentiment gets so negative that everybody's worried about the Fed or the Treasury not being able to finance the U.S. debt. I'm not saying that that's going to happen, but it starts to feel like that, especially if these rates go higher. I mean, we're looking, I think, at these rates where we are right now, just a touch over, we're looking at $1 trillion a year just to pay the interest. So all of these scenarios, folks, I've been around a long time and we've been talking about these things for a while. Just happened to come up tonight. I said we're going to get done quick. Here I am going off on this, but this is one of those things where if these scenarios start to happen, then this is going to go on. And so there is probably like no other time. There's nowhere to hide right now. I talked about investment advisors that are doing 60-40. You got bonds going down. You got stocks going down. They're not doing well. And for the first time, I think, and I've dealt with this community for a long time, for the first time, the 60-40 guys are getting squeezed to the point where they want to get some cash. Because normally, they just do a small amount of cash. They're starting to wanting to go to cash. When the bond markets top out, when those 60-40 guys start to actually go into cash and actually sell bonds, then that's the capitulation point. Sorry to get off on that. I know I have our investment advisors and plenty that watch this broadcast, but this is probably one of the more important things to pay attention to right now. So I think I'm done. Let's go ahead and get into, we got crude, gold, and Bitcoin to cover, and let's go ahead. All right, so crude oil, we're trading 83.29, down a little bit. This is kind of a broken record story here, and the broken record is crude is likely to stay between around 82. We printed down 2 weeks ago. We printed down to 80.75. We should continue to remain in this area, but we have an issue of a very strong down ppm 1, which is 1.15, and we did see, and I talked about this a couple weeks ago, this happened this week where the 10 period has crossed over through the 40, and typically we should get some stability here. We should hold this 80 level max, but I'm pricing in an 82-92 range right now, and we're starting to see a little bit of movement on gas, on unleaded gas, and some other elements out there, and we're looking at nat gas has rolled over big, so the whole scenario of how expensive it's going to be this winter for folks in Europe. I think, as I've said before, there's people out there trying to fix this issue, whether they fix it or not, or whether they're going to control consumption or whatever happens, then it looks like even that gas, I won't bring it up tonight, but I mean, we could do, maybe that's what I need to do, is just do a full spectrum of everything and do a long stream and just focus and get that organized. That might be worth doing. But the bottom line is, crude is still in this upslope, and real quick, I'm going to bring up the monthly graph here for a second. We still have this upward sloping 10-period moving average here on the monthly, and the PPMs are at 0.34. So that number is at 88.98. We'll call it 89. So I still see as we come into the month of October that we are going to want to hover right around there. The 200-month average is 88.42. So there's some attraction there to the markets from that standpoint of going up. And the bottom line is the big major support is down at 69. If you look at the market grid here, 80.14 was S2. That's exactly pretty much where we went. We went to 80.75. So we're staying within the grid, within the expectations. So the market grid is an estimation of volatility on a bar by bar basis. So you can run on a 1 minute or a monthly chart or a weekly, and they give you some really good estimations of where markets are likely to stabilize, and that's why we go through that every night. I've been using that technique was developed way back in the early 90s, actually, around 1990 or something like that. Actually, it was 1989 when that process was created, and it was created for hedging firms that I was dealing with at the time to give them the best points to buy or sell in a day, whether they're sell side hedge or buy hedge. And same thing, we have the same issue as traders. If I like a market, where do I want to buy it at? I want to try to buy it at the best price. So that's what the market grid does. And those of you who have the indicators know how effective they are. And I have a new enhancement coming out. Hopefully by Monday, there'll be some really cool stuff where you're going to be able to display the daily values on the intraday chart. Do some really cool stuff so you can actually see the trading values intraday. So if you haven't got the indicators, the link is right here. Check those out. But the entire oil complex is been under pressure we'll go for the last 3 months, and I think we're finally getting to that point of where things are going to balance out here. So, but that's my best estimation in this range. We're calling 82.92 again. Next, we'll take a look at gold. This is what I was talking about earlier in the opening comments, and we're looking at a couple things. So this is weekly. 1620 is a Fib target 1. We've not been able to get down there. We continue to hover down at the lower end of the range the last 3 weeks. If we look at the market grid, the low's been 61 for this week. S2 is 1653, so basically an S2. On the upside, almost exact print. R1 was 1697.90. We printed 1696.90, so $1 off on that. So it's staying within those ranges. The weekly ranges are usually very good from estimating that range. It will be interesting because PPM1 is still negative but turning up. And if we stay stable coming into next week, we could start to see some upward acceleration in PPM2 and 3. And that's going to be what I'm watching for here. It's hard to imagine, as I said earlier, that gold's going to do anything with interest rates going up like they are. It's got to be geopolitical. The bid has to be based on that, fear-based trade. But the logic trade says we should be in the 1500 handle. We should not be anywhere near where we are. But it's holding here, and I think folks are putting the bet there just for the whole gold safety situation. So, but anyway, this is the setup looks pretty interesting. I'm looking forward, and we come into the end of the month. The monthly charts don't look very good. They're still under a lot of pressure. So just the weekly charts, but it starts there. So anytime you're looking at a chart, you're going to see daily lead to weekly, weekly lead to monthly kind of turning point. And maybe we're getting that with these PPMs here. We'll have to just continue to watch for the next several weeks. We're probably 3-4 weeks of stability to get that to go. And like I said, if we keep seeing these rates punch through, there's going to be, I think, a breaking point here. But paying attention to these PPMs on an intermediate basis. Okay, final market we'll look at is Bitcoin. Another market that probably shouldn't be where it is, defying gravity. We got down to the 18,691 just last week. This is weekly. This week we got down to 18,188. So we kind of penetrated through that 18,635, right in that range. We've traded down to the extreme. What's interesting here, folks, is that the PPMs are stabilizing here. It looks like we're getting big acceleration. Now this chart doesn't change or update until on Sunday evening at midnight on Eastern time on Sunday. So, but still trying to hang in there. And we pressed the lows and not being able to follow through. I'm going to bring up the daily chart just for a second here to finish off. And we do have some downward fib targets that have been around for about 4 days now, and they're projecting 16,112, 13,572, and 12,013. So if anything goes wrong and we get maybe a big surge, even bigger surge in the treasuries, or some of this scenario that I have that I'm just suggesting is something to watch out for, then that is really, that would crush this market for sure. But even on a daily basis, there's some stability in this lack of trend. We'll just say it's stable. It's not really trending up or down. It's actually a slight downtrend, but it just keeps holding these key levels. So if you're in there, maybe you're hodling anyway, so it doesn't matter. But if you're trading it, I'd be very cautious. But the way it's trading, it looks a lot better than it does worse from the standpoint of how the patterns are unfolding here. Okay, folks, that's going to do it for this week. And what a week it was.
Riot is making some changes to Blitzcrank. Let's check it out. For starters, his base attack speed is getting a buff alongside his attack speed ratio. His W is getting a huge buff with the attack speed being increased from 30 to 62% to 40 to 92%. The mana cost is being increased by 10, but it has a new effect where Blitz now deals 1% max HP magic damage on hit while active, increased by 60, scaling to 180 against non-champs. His E mana cost has been increased by 15 and also has a new effect. It now scales with 25% AP and is increased by 150% AD and 125% AP against non-champions. His R passive AP ratio is being increased from 30% flat to 30 to 50% scaling. Let me know what you think of these new changes in the comments below. As always, thanks for watching.
Hey, what's up, YouTube? My name is Alex, and I graduated from Stanford in mathematics and computer science. I'm a data guy, I'm a software guy, but there are two things that I really love. The first is betting on sports and beating the sports books, and the second one is pretty related, but it's writing software to help myself bet on sports and beat the sports books. I think why I've always been so fascinated by sports betting is, unlike other forms of gambling like slots or roulette, in sports betting, you can actually have a mathematical profit margin over the sportsbook and win in the long term. And that's what these videos are going to be about. We are going to talk about becoming a more data-driven, a more mathematical, and most importantly, a more profitable sports bettor. So there won't be any fancy graphics, no fluff, no BS. I'm not a movie producer, but I hope you watch until the end of this video because we are going to talk about key concepts to making money in sports betting. Now, me personally, I have profited over $400,000 since regulated sports betting came to the United States in 2018. I've never done it full-time, and I would never even consider doing it full-time. And in this video, I'll try to weave in my experience to share, show, and prove to you everything that I am saying. Now, very briefly before we dive in, I want to make very clear, I'm not saying that sports betting in the US or Canada is easy, because it's absolutely not. I have spent thousands of hours building models to help myself bet on sports, writing software to identify line discrepancies and profitable betting opportunities. It is not easy, and sports betting is never going to be a game for the impatient, those who want to get rich quick, and even the slow. To be a great sports bettor, you have to be fast, disciplined, and also mathematical, and that's kind of what we're going to talk about. So before we dive in, we can take a look very briefly at one of my sportsbook accounts, DraftKings, just to see, before I started OddsJam, how seriously I was betting.
So here we can see an example of what one of my many sportsbook accounts looks like. So this is my DraftKings, and there are nights between sportsbooks I've had over $50,000 bet spread across, 35 plus bets, all on bets that are mathematically profitable. So you'll see wins and losses here. Nobody wins every time. It's all about finding odds in your favor so that you win in the long run, right? It's kind of like investing. You won't win every day as a profitable bettor. You obviously won't win every bet, but over the course of the long run, you will make money. And for me, it's a pretty incredible feeling to know I have a mathematical profit margin in every bet that I place, sit back and ultimately watch games and let the math work itself out to make me money. So yeah, pretty crazy account.
The last thing I'll say before we dive in is that if you like this content, please like, please subscribe, please share. That's really the only way I know that this content is actually valuable to other people. And please do not hesitate to reach out with that. And it is the realization that sports is a financial market, just like the stock market. My background is I worked as a quantitative trader on Wall Street, and I understand this may sound very weird to some people, but in sports betting, it is not about sports. It is not about picking winners. It is about identifying inefficiencies and odds on US and Canadian sportsbooks and taking advantage of them. And there are a lot of inefficiencies on US and Canadian sportsbooks. Now, when I say financial market, there are two important parts to that. The first is that sportsbook odds are not static, and second, they are determined by supply and demand, and things can move quickly. Just like the price of GameStop stock can go from $160 one minute to $200 the next minute, in sports betting it's exactly the same. If Kevin Durant gets injured, maybe the Nets in tonight's game go from minus 200 odds to minus 120 odds in a matter of minutes. The Nets are less likely to win, and that's reflected in the odds. At the same time, maybe Kyrie Irving is expected to have the ball more, and his over 30 points goes from minus 110 odds to minus 210 odds. Again, odds are constantly changing across bookmakers as new information is absorbed into the market and bettors place bets. Supply and demand. So yeah, that's concept one. Sports betting is a financial market like all others. And this is really important to understand because unlike other markets, the sports betting market is very inefficient. You have hundreds of bookmakers in this global ecosystem, largely setting odds independently, firing a bunch of algorithms, trying to balance supply and demand on both sides and update their odds. And this yields a lot of interesting inefficiencies, which we can look at right here.
Here's an example from OddsJam of just how crazy the sports betting market is. You have all these books running around trying to set their lines independently. So here we can see an example from the Yankees-Twins game tomorrow. The Twins, for example, are plus 180 on BetMGM. They're plus 215 on Fox Bet. Could you ever imagine placing a bet plus 180 odds on BetMGM if you knew you were getting plus 215 on Fox Bet? It's absurd. Now, if you think these discrepancies in odds, like the difference even between plus 200 and plus 215 is small, then there is a massive, massive flaw in your thinking. Sports betting is all about earning 1% to 7% profit margins on a daily basis and watching those returns compound and compound and compound. If you think about the stock market, people get rich investing in the stock market, which returns like 8% per year on average. So imagine if you could earn 3% per day in sports, right? That is the goal. Earning a 3% return on capital every day in sports betting and watching your returns compound and compound and compound. Now, let me tell you, that is never, never in your life going to happen if you're placing bets at plus 180 odds and plus 200 odds when there's another sportsbook in your location giving you plus 215 odds. These small differences, or seemingly small differences in sportsbook odds and the line discrepancies, add up to a lot of money in the long run. So this is kind of an example of what all these sports betting markets setting lines independently looks like in real time.
So if you think about it, this difference in sportsbook odds is actually really fascinating and pretty mind-boggling, right? Like, it doesn't happen in the stock market. It's not like I go to Robinhood or E-Trade and I see a different price on Apple stock. It doesn't really make sense. But in sports, clicking one tab over from Barstool to BetMGM can really change your payout in a big way. So a lot of people may be wondering, well, that doesn't make much sense. Why do all these sportsbooks have different odds? Why don't they just copy each other? And the reason for that, because it's a great question, is all sportsbooks, they largely want to be unique. DraftKings, they don't want the same odds as FanDuel. They don't want the same odds as BetMGM or Pinnacle, right? We wouldn't need hundreds of sportsbooks in this global sports betting ecosystem if every single sportsbook had the exact same odds. It wouldn't make sense. These sportsbooks largely want to be unique, set their own lines, have their own models, and do it themselves. From a sports betting perspective, it works in favor of the book because you need multiple sportsbook accounts to be successful. This is called line shopping, and it's browsing odds between different bookmakers and only placing bets at the best possible odds. You do not want to get ripped off by sportsbooks. You should never be placing a bet on BetMGM at plus 145 odds if you can go one tab over in your state and place that bet on DraftKings at plus 160 odds. So line shopping is a very important concept in sports betting, and doing it ruthlessly adds up to a lot of money in the long run. Don't get ripped off by the sportsbooks. Only take bets on sportsbooks that are offering you the best odds. There are like 50 plus regulated and offshore bookmakers in the US and Canada. You should have as many accounts as possible. It takes like 2 to 3 minutes to create an account. When I was actively really betting before I started OddsJam, I had like 30 or 40 sportsbook accounts that I used. WinBet, PointsBet, William Hill, DraftKings, FanDuel, MGM, BetUS, tons of them. You never know when there's going to be a great opportunity with great odds on a particular book. So having more books, it just increases the number of possible profitable betting opportunities that you can place. More books, the merrier, in my opinion. The one thing we're not really going to talk about in this video, but it's worth mentioning, is a lot of these sportsbooks offer sign-up bonuses if you make an account with them. DraftKings, FanDuel, Caesars, they all do it, right? And if you think about it, a lot of people think it's too good to be true. Like, how are these sportsbooks giving you $1,000 to sign up? If you think about it, they're in ruthless competition with a ton of commodity businesses, right? These are all commodity businesses. They're sportsbooks. They accept wagers. DraftKings has to compete with FanDuel, has to compete with PointsBet, and they offer users like $1,000, $2,000 in free credits or some promotion to sign up. So knowing how to do these sportsbook sign-up bonuses and promotions in a mathematically optimal way can actually lead you to a lot of money. So I started betting in Pennsylvania, but I went to New Jersey with a friend. I stayed in Hoboken, and I calculated at that time that New Jersey sign-up bonuses, if you knew how to do them right in a mathematically optimal way, between Caesars, William Hill, like you add up everything, we're talking about like 5 figures that you can make just from sign-up bonuses alone in New Jersey. So I would recommend, there's a lot of content online about sign-up bonuses, but if you have questions, you can also email us because this is one of the easiest ways to make money sports betting. So there's another reason that you are going to need multiple sportsbook accounts, and that is limits. Limits. My least favorite word, but this is a question I get a lot from friends, former colleagues I've worked with, is, well, if you're a profitable sports bettor, why can't you just bet bigger? In other words, if you have a 3% edge, you're betting $1,000 and you're getting $30 in expected return, why can't you just start betting bigger? And the reason is because of the limits in the business model of US and Canadian sportsbooks. I'll be the first to break it to you. You're never going to make $1 million off of a US regulated or Canadian sportsbook. And the reason for that is limits. This is why sports betting is unscalable. And honestly, becoming a professional sports bettor is not lucrative. And everybody who claims to be a professional sports bettor is really just starting a company to try to sell you something. In sports betting, the sky is realistically not the limit because of bookmaker limits. Now, when I say limit, all I mean is if you start betting out on FanDuel, for example, when I started betting on FanDuel, I could place $5,000 per bet on basically anything. If FanDuel determines that you are a winning bettor, a mathematically profitable bettor, that limit will slowly come down. Now I can barely bet more than $50 on FanDuel. And on the other hand, if you're a losing bettor, the sportsbook will take your limit up. So basically, you start out being able to bet a lot of money on all of these sportsbooks, but if these sportsbooks determine you're smart and mathematically profitable, these limits will slowly come down. And again, this is why you probably don't know anybody smart who is a professional sports bettor, and why it's really an industry that attracts zero talent and technical people. It's solely because of limits. Regulated sportsbooks are not in the business of taking people's money who are smart. They are in the business of limiting people who are smart and keeping around the losers. That's just how the industry works. And that also means if you know people who claim to be really great bettors, but they're not getting limited, they're probably just not profitable. Getting limited is oddly a sign of success. I'll be very clear here. Limits are a function of profitability. I've run models to prop bet. That's gotten me limited. I've obviously written software to identify line discrepancies. That has gotten me limited. If you are making money, you will inevitably get limited. And at the same time, if you think you're making money and you aren't getting limited, maybe track your bets and get your exact profit and loss because you probably aren't making money. Yeah, I've personally been limited by almost 20 bookmakers at this point, which is pretty crazy. But again, it's just part of the game. This is just how the industry works. Sportsbooks are in the business of limiting winners and keeping around the losers. This isn't meant to discourage anybody from betting on sports. Obviously, sports betting is really fun, especially if you're making money, and it can still be lucrative. It's just to say that you're probably never going to make $400,000, $300,000 off of one sportsbook. You're going to get limited well before that. The goal is to make $20,000 maybe off of 5, 10, or 15 sportsbooks. That is really your goal here. The power is in the number of sportsbooks you have. And again, with this crazy wave of regulation and legalization in the US as well as Canada, there are a lot of different bookmakers you can get. So do their sign-up bonuses, take advantage of them, make as much money as you can, but you will lose some accounts. Like again, here we can see my FanDuel profit. 38,000, not terrible, but I can tell you, this will never probably even pass 50,000 because I can barely even place a bet on the product anymore. The power's in the number of books you have. One final point I'll leave you with because it's kind of fun, kind of interesting, is in the US, different states have different sports books. For example, I'm in Virginia right now, so there's WinBet, I can bet on WinBet. I'm in Pennsylvania. So long story short, you do not need to physically live in the state to bet on that state, You do not need to live in the particular state. So I actually, I've spent some time traveling. Like when I've been in Nashville, Tennessee, I've created a sportsbook account, done the sign-up promotions, or Vegas. So I highly recommend if you are traveling, check if you're in a regulated location, and if you are, you can still bet on sports, at least take advantage of the sign-up bonuses and have some fun sports betting while you're there.
So we can go through a really quick use case of line shopping. So basically there was this FanDuel promo, and I don't want to spend too much time talking about it, but on every Tuesday, you wanted to go through in every single baseball game on Tuesday, you wanted to bet $25 on a player to hit a home run. Essentially, you were given some bonus if you did this. So every Tuesday, a bunch of people would be talking about who should I bet on FanDuel, for this specific game to hit a home run. So let's go over a simple use case of line shopping and just kind of see how easy it is. So what we can see here is it's pretty late at night, so we see only 3 books have posted player to hit a home run, markets for tomorrow, but this is the Reds-Marlins game. So let's say you wanted to get a head start. What you'd want to do is look for players where FanDuel is simply offering you the best odds, right? Why would you ever place your promotion bet on Alex Jackson over 0.5 home runs, so to hit a home run plus 300, when Pinnacle Sportsbook, the sharpest sportsbook in the world, which is on the OddsJam plus EV page, is giving you plus 359, right? This plus 300 is pretty clearly a crappy bet. So all you want to do essentially is look for ones like this, right? Like this one is great. Here we see FanDuel is offering you the best odds, plus 230 odds, and that's on Joey Votto to hit a home run. He's obviously been pretty hot. The odds are better than Betfair. The odds are better than Pinnacle. So maybe Joey Votto is a good choice. Or maybe Sanchez is a good choice, plus 440. This one also maybe. Kyle Farmer, plus 550. He's only plus 500 to hit a home run on Betfair, and only plus 437 on Pinnacle. So this is a pretty powerful tool, because essentially if you would have selected the best lines from FanDuel over the course of the promotion, you would have netted over $2,500 just from this one specific promotion on FanDuel in betting the best home run lines. So in my opinion, this is really what I love about data-driven software products, right? No one can argue with live real-time odds. This isn't a BS model. This isn't BS picks, right? This is literally real-time data. And the way you know you are getting good odds and you are making a good bet on FanDuel for this promotion is you place bets where FanDuel is offering you the best odds on that player to hit a home run.
So in this video, we talked about the fact that if you want to make money sports betting, you are going to need multiple sportsbook accounts and you are going to need to line shop ruthlessly. Again, the point of sports betting is earning like 2% returns, 3% returns on a daily basis and watching those returns compound and compound and compound. Now, what's really interesting is if you think about all the different sportsbook accounts you could get in New Jersey, and if you think about all the offshore books like Bovada, BetUS, if you add up the total amount of odds on these sites at any given time, we are talking about millions and millions and millions of odds. And it's a lot. These odds are always moving, as we kind of talked about. So in my opinion, at least, it's nearly impossible to find good bets manually. It's not going to happen. Odds are always changing. Good lines don't last forever. Anybody who's made serious money sports betting will tell you you need good software if you actually expect to profit in sports betting. That's why I initially built OddsJam, right? I wanted to make software to save myself time and make myself more money. Of course, at this point, I've been limited by basically the sportsbook. It's not as useful for me, but hopefully for you, it can save you time and money. We process millions and millions of odds every single minute, powered by hundreds of servers to show you some of the best betting opportunities, as well as live odds from around the world. It's a pretty powerful tool because there's no fluff, no BS picks, no BS models. We just build tools based on real-time odds. And what's better than building tools based on real market data? We also power a lot of companies in the industry through our real-time API of live odds. So I encourage you, we'll talk about OddsJam more in other videos, but to check it out, we have a lot of free features, a bet tracker, free line shopping, and just see if it's something that can improve your betting game. Even just line shopping, if you are betting on sports, just make sure you are getting the best possible odds and you are not getting ripped off by the sportsbooks. It's really important. And at OddsJam, we're just getting started. We are building tons of new tools based on live odds from around the world, paired with historical data to build some insanely useful tools for our users, we hope. So a lot of really cool things coming with OddsJam, trying to bring really the best of Silicon Valley engineering directly into a sports betting product for retail sports bettors in the US as well as Canada. So that's a bit about OddsJam. I hope you enjoyed this video. Again, if you want to hear about more topics, odds boosts, promotions, sign-up bonuses, whatever it is, feel free to email me or just comment, like, share, subscribe. It's good feedback for us that this content's actually valuable to other people and other people are interested in actually making money sports betting. So again, thank you for your time. My name's Alex, and until the next one.
Hey guys, welcome to the channel. So this is going to be a completely free beginner's guide to investing in cryptocurrencies. It's going to be very long, it's going to be very in-depth, but it's going to go over everything you need to know to start investing in the cryptocurrency market today. And if you guys don't mind, make sure to hit that like button and subscribe to support this channel. Let's get started with the course. So let's talk about the things that we're going to cover in this course, right? First, we'll go over my background as an investor, why you should listen to me. Then we'll go into why you need to invest as soon as possible. We'll be talking about why you need to not time the market, but rather be in the market for a longer period of time. Then we'll go into an introduction about cryptocurrency, basically what it is, what blockchain is. And if you guys are interested in actually making some money with your computer, we'll also talk about crypto mining and how you can make some passive income doing that. Then we'll go into some of the very popular cryptocurrencies right now. And with that, we'll go into what dictates the value of a cryptocurrency. Why are some cryptocurrencies expensive and why are some of them super cheap? We'll talk about the risk of investing in cryptocurrencies, you guys. It's not the most safe investment out there, but in the last few years, we've seen that cryptocurrency can make you a lot of money. Now, the gains in the past don't necessarily mean that you're going to make money in the future, but it's just cool to see how much money people have made with crypto. Then we'll go into what crypto wallets are and the types of crypto wallets. And then the section after that, we'll go into the different types of platforms you can use to actually invest in cryptocurrencies. I'll actually be taking you guys through each of these platforms and showing you guys how to use them. Then we'll talk about an online crypto savings account that I personally do use. And then after that, we'll talk about doing your own due diligence and researching for different cryptocurrencies. This is extremely important because you don't want to invest blindly. You need to know what you are investing in. Then we'll go through some important valuation metrics I use to actually analyze different cryptocurrencies, as well as talking about important qualitative indicators of what makes a good crypto. I'll then teach you guys how to read a white paper, as well as some really great crypto news sources that you guys can go to learn more about cryptocurrencies. Then we'll talk about what tokens are and initial coin offerings, ICOs. I'll give you guys my own research and beliefs about timing the markets. Then we'll go into the Crypto 20 Index Fund, which is just a pretty cool way to invest in cryptocurrencies. And then we'll talk about how much money you should invest. This really depends on your situation, but we'll go through some different scenarios.
But you're right, and we've said this. This is a strong, robust economy.
Right now to inflation, because it has begun to cool, but food prices remain high, and that is making it difficult for many families to afford even basic groceries. Food banks across the country are feeling the impact of high prices with long lines and new faces as more families struggle to make ends meet.
People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there.
If you've been using your credit card a lot recently, you're among the millions of people who have racked up debt at record rates.
In a few months, there is a good chance that the total credit card balances of people in this country will soon reach a new record.
Finds that only 44% of Americans can cover an unplanned emergency expense of $1,000, with 35% saying they'd need to borrow that money to get by.
The states are very flush with cash.
State of emergency in Jackson, Mississippi, 160,000 people there still without drinkable water. People lining up for hours for cases of bottled water today, some finding they were already too late.
So there's a good reason to think that this will continue to be a reasonably strong economy. A reasonably strong economy.
What the are you talking about?
All right. Today is Thursday, September 22nd. This is a recap of the stock market activities today. Folks, I got a good one for you tonight. And look, the action today was supposed to be a lot uglier, but there was a save overnight, or at least we thought so, until of course the digestion started to kick in, and all of a sudden the market decided to take a Pepto-Bismol to the downside. This supposed save, maybe not, came out from the Bank of Japan overnight. We know that the yen has been getting crushed severely, like we have never seen before, at least since the 1990s. And the question was, will the Bank of Japan at some point fall and stop easing their monetary policy, perhaps increasing interest rates higher to shore up the yen once again? Well, now we know the answer. They're not doing that. They're keeping rates as is. But they did intervene for the first time since 1998 to shore up the yen. Now, when they push the yen higher, the dollar goes down. When the dollar goes down, the algos react right away. And the algos like the US dollar to go down because this allows a rally in equities, at least in the metals, materials, energy, those kind of sectors, the stock market, commodities. But also multinational technology companies because they get a lot of revenues from overseas. They like a lower US dollar. But there is a catch. How would the Bank of Japan shore up the yen? The answer is by dumping US bonds. Well, when they dump US bonds, what happened to yields? Yields shoot up higher again. We saw the 10-year yield, the 2-year yield shooting up significantly higher today. Now, the algos react to that in a negative way, specifically when it comes to the NASDAQ, the big cap technology stocks, the RKKs and speculative kind of stocks, the high multiple kind. And therefore, today we saw a contrast in performance between, let's say, the Dow Jones versus the NASDAQ and the Russell 2000. The Dow Jones outperformed, the NASDAQ, the Russell 2000 underperformed. And the reason is, a lot of these value names, these material and oil names, and the Dow Jones, they reacted positively to the fact that the dollar went down, at least initially, when we heard about the Bank of Japan shoring up the yen. Yet the algos reacted negatively to the fact that the 10-year yield shot up higher, and they sold the NASDAQ, technology, the high multiple kind of names. And as a result, the NASDAQ and the Russell 2000 underperformed today. But it wasn't just the Bank of Japan. It was a double whammy, triple whammy, whatever you want to call it, doesn't matter to me, against the US dollar. For example, overnight, the SMB, the Bank of Switzerland, which was the only country with negative interest rates, well, they decided to increase interest rates by 75 basis points, and moving out of negative rates territory. Remember, when other central banks start to tighten their monetary policy to shore up their currencies higher, well, guess what happens to the dollar? It goes down. And of course, the SMB is way behind the curve. They have some rosy projections about inflation, and then all of a sudden, month after month, those projections were getting up higher and higher and higher. And here, let me fix this one for you. Oh, here it is, much better. Inflation to the moon. And it wasn't just the Bank of Japan and the SMB. It was the Bank of England. It was the Norwegian Central Bank. It was the Indonesian Central Bank. All of these countries increased their interest rates significantly higher, with one exception, that is Turkey. Over in that country, they actually decided to cut interest rates by 100 basis points. So you might say perhaps inflation is crashing over in Turkey. The answer is not really. Inflation is actually at 80%. But of course, genius Erdogan continues to cut interest rates, hoping that inflation will magically go down. And I say good luck, Mr. Erdogan. Best wishes. Maybe US market bulls will move over to Turkey, since the central bank is spreading a lot of yayo over there still. Because the bulls are getting really desperate at this point. They're looking at anything to grasp on. They looked at the action that we got from central banks this week, and they said, oh, look at this. The Norwegian Central Bank, yes, they increased interest rates higher, but they signaled that interest rate hikes are coming to an end. And of course, the bulls right away went, maybe Jerome Powell, maybe the Federal Reserve will also put an end to interest rate hikes. I say not so fast. Unfortunately, of course. Because yesterday, Jerome Powell came out as Dark Powell. He certainly did not walk the walk by increasing interest rates by 100 basis points, and perhaps more, but he did indeed talk the talk. And there was a lot of talk. So let's go over what he said, and here it is, in focus tonight. Introducing Dark Powell, no longer Dove. For good this time around, 100% sure. And he's not just only a hawk, he's becoming a Maverick Wall Street kind of hawk. You know, some men just want to watch the world burn. And by now, you know the deal. They did the 75 basis points, plain vanilla. They added a bunch of sprinkles and M&Ms, and they said, okay, here we go. Please don't buy stocks. Please press the sell button. Please short more. The Fed is in your side. Don't fight the Fed. Of course, we're going to talk a lot about unemployment because this is the missing block. You want the Fed to stop? Unemployment must rise higher for inflation to go down. And of course, every time, just like the S&P, month after month, they continue to raise their unemployment projections. And I say, let me fix this one for you. Here it is. Much better. To the moon. But what I would like to do here is, let's go over certain statements. We start with the bearish ones, hawkish ones, because we must answer to two important questions. What is the magnitude of pain that Jerome Powell is looking for in the economy? And number two, when is he going to pivot? And here's an extra one. Number three, what indicators should we be looking for? And he answered all of these questions. Let's start by Jerome Powell reiterating his stance from Jackson Hole. Take a listen.
The main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
So Dr. Payne said, I'm not joking about what I said. I mean it. I want to see a lot of pain. What kind of pain are you looking for, Mr. Powell? Well, here it is. Take a look.
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. You know, higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
And is there a painless way to do this, to take inflation down? Because you got genius Senator Elizabeth Warren now criticizing Powell, saying maybe we should let inflation go. MMT, baby, to the moon. I thought Republicans are the ones who were telling Powell, please stop tightening the monetary policy, keep the money loose so we can goose up Wall Street and the oligarchs and the real estate market. I thought this is what these Republicans stand for. All of a sudden, Elizabeth Warren is now standing with that same side, saying, Mr. Powell, stop tightening the monetary policy, please. More easy money for the billionaires. So again, Mrs. Warren and everybody else, is there at this point, at this stage, we can talk about, spilled milk from last year, or the Fed should have raised interest rates higher last year. No other channel, no other outlet has been beating on this drum over and over and over and over again than this channel. But we're here now. And at this stage, since the Fed is too late, is there a painless way to get rid of inflation? Here's Doc Powell once again.
If we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation. And that's what we're doing. And we certainly don't hope, we certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
And oh, by the way, what happened to the soft landing? I guess the soft landing is kaput right now. Take a look.
In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
If you thought that was enough, you're already crying with the tissues, you already shit your diaper, we'll grab another one. Because Jerome Powell says, I want to see pain in the stock market. Stop buying the dip, you morons. Take a listen.
Of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation.
And this is really important because Jerome Powell says, I know that there is a lag. Whatever I'm doing right now in increasing interest rates, that's going to show up later. But what is the explanation behind that? The explanation is financial conditions tighten. That is the first step. And then little by little, we see that tightening of financial conditions being spread all over the economy in terms of higher unemployment and a slowdown in the pace of economic activity, aka slowing down of the demand in the economy. And that leads to lower inflation. So Jerome Powell told us that we have to keep an eye on financial conditions. And pay attention now. At this stage, they cannot afford to let financial conditions get loose again. They have to get financial conditions as tight as possible for inflation to go away. So when we look at financial conditions right now, they're indeed tightening. But the devil is always in the details. You see, this is the Chicago Fed National Financial Conditions Index. Financial conditions tighten when we see the readings in this index shooting up higher to positive, above zero, just like we saw back during 2009, 2008, and just like we saw back in 2020. Look at financial conditions right now. Yes, we're tighter than a few months ago, but we're not really that tight. We're not tight enough for inflation to go away and be removed from this economy. We dig deeper. This is really important. Pay attention now. What happened in 2022? You see that little dip in financial conditions? The reading went tight for a little bit, but then it went down. Why? Let's zoom in a little more. Here it is. Remember what happened? The so-called June bottom, the summer rally? Well, that pushed financial conditions to loosen, not to tighten. In other words, for financial conditions to tighten to the point where the Fed says, okay, this is good enough to extract inflation out of the economy, this reading has to go higher, much higher than it is right now. In other words, if you geniuses keep buying the dip over and over and over again and loosen financial conditions with these bear market rallies, I, Jerome Powell, have to whack your little head even harder to get the message through. I want to see financial conditions tightening significantly for inflation to go away. And what you geniuses are doing by buying the dip over and over again, you're effectively screwing with my progress. So I have to come out even more aggressive. No wonder why he had to come out in Jackson Hole and do the Dr. Payne speech. Do you understand now that buying the dip is suicidal at this point? Now, let's go back to Dr. Payne. But this time around, I want you to grab a pen and paper or iPad, whatever you use, doesn't matter to me, and take some notes. Jerome Powell is going to give us 3 conditions for when he's going to say, okay, we've done enough, now we pause, in terms of increasing interest rates further. Let's see if we can catch all of them. Take a listen.
What we'll be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
So this is what I got in my notes. He wants to see growth moving down. He wants to see unemployment moving higher. And he wants to see inflation moving down. What does that mean? What is this an ingredient for? And the answer is a recession. What else should we be looking for, Mr. Powell? Because why is he front-loading all of these interest rates hikes right now, doing the 75 over and over and over again? What does he want to see? If he has to name one indicator, take a listen.
What's the incentive to continue front-loading right now? Is it a lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
So Powell says, I have to front load all of these interest rate hikes because the core PCE, are you listening or not? The core PCE, forget about the CPI, core CPI, PCE. He's looking at the core PCE. And until the core PCE gets closer to 2%, the Fed's target, they're not going to stop raising interest rates. They're not going to stop tightening the monetary policy. In other words, let's say the core PCE right now stands at above 4%. That is double the Fed's target of 2%. In other words, back to Volcker, how do we defeat inflation? By raising interest rates above the rate of inflation. Okay, you might say, hey, the CPI has rents and housing, and that could tilt things one way or the other. And the headline readings with energy and food, those are volatile. Okay, let's play that game. You want to play that game? Let's play the game. Let's use core PCE, which stands at above 4% right now. This means the Fed has to increase the Fed funds rate above that number. In other words, 5%. We are now at 3.25%. So by my calculation, we have at least 175 basis points worth of hikes coming. The sooner, the better. And Jerome Powell understands that. So why isn't he doing it right away? Just get it out of the way. Go ahead and do the 5% right now. Shock and awe. Get inflation out of the system right now. This is what we mean when we say the Fed is behind the curve. Look at what the 2-year yield is doing. The 2-year yield is above 4% right now. And it is saying, Mr. Powell, can you catch me or not? You're not in the driver's seat. I am. The next step would be the 2-year goes to 5%. Now Jerome Powell goes to 4%. And then the 2-year goes to 5.5%. Jerome Powell has to go to 5%. And it becomes a cat and mouse game that is so dangerous. But if Jerome Powell goes above the 2-year right away and moves interest rates to 5%, effectively he tells inflation, I'm in charge, not you. And now I'm going to push you down. And you're going to follow my lead. But do you think Jerome Powell has the balls to do that? Of course not. Now, was there anything bullish, anything dovish in the conference that we got yesterday? The answer is maybe a point or two. Here's point number 1. Jerome Powell again shifting the blame from his own monetary policy mistakes to, oh, these are just supply shocks. But he also says something important. Let's see if we can catch it.
Part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation.
So now, of course, he shifts the blame to supply shocks, the thing, Russia, Ukraine. And he says, look, some of these supply shocks are resolving themselves. We're seeing commodities futures going down. He said peaking, maybe. So that is one tiny glimpse of hope that the bulls can hold on to, which is what if futures, in case of commodities, continue to go down? That would be a bullish sign that Jerome Powell perhaps will see it as inflation moving down. The problem is, look at what's going on with wheat, look at what's going on with natural gas, with crude oil futures. They're moving higher again. Okay, what else? Do we have anything else that is bullish or dovish? Yeah, kind of. We have the fact that Jerome Powell, after saying that the soft landing is kaput, he came out later on and said, oh, maybe we're still keeping an open mind that the soft landing could happen at some point. Take a listen.
First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored, and as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability.
And of course, let's conclude by the fact that Jerome Powell remains delusional, a delusional madman, despite the fact that he's getting darker. Because in conclusion of this conference, he went on and said this.
We've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go.
And I say, Mr. Powell, good luck. If you think your trajectory is going to do the job in killing inflation, good luck. You're not going to kill inflation until you get ahead of inflation, until you move interest rates above the 2-year, above the core PCE. Then you got a fighting chance. But with this course of action, being a chaser, a follower, not a leader, you're keeping inflation in charge. What if these supply shocks intensify for whatever reason? Natural disaster, Russia, Ukraine, and we see inflation moving higher again. Then you got to chase and come out with even a larger interest rate hike. But hey, rest assured, if you thought that this is just FUD, that I'm just scaring people and all of that, you got JP Morgan to soothe your pain and your fear. JP Morgan says the Fed will save the stock market and cut interest rates if a deep recession occurs next year. So buy stocks now, damn it. We're holding a massive bag. At least this is according to Kalanovic from JP Morgan. Buy now, then the stock market crashes, the economy gets into a deep recession, and at that time, the Fed is going to pivot, cut interest rates, and stocks go higher again. And from that point, it takes you 3 to 4 years to get back to even. Genius, isn't it? Anyhow, folks, let's move on and cover the stock market information for you because we have a lot of important discussions, specifically when it comes to the dollar, the chart of the US dollar. But let's start with the closing of the indices today, and here we go. The Dow Industrial Average closed in the red, down by 107.10 points, or a loss of 0.35%. The Nasdaq down by 153.39 points, or a decline of 1.37%. The S&P 500 down by 31.94 points, or a decline of 0.84%. That last-minute puke will be also by the closing bell. Otherwise, equities, the Dow Jones was positive until the last-minute puke. And as a result, the performance of indices was abysmal once again. No metals at all in the red, led by cyclicals, industrials, and technology. The advance to decline ratios, NYSE are pathetic. 17% advancing versus 81 declining. 81% I should say, declining. The Nasdaq, 16% advancing versus 81% declining. Now again, we keep saying this all the time. With such suppressed ratios, you got one of two things. Number one, a big crash is in the process right now. Number two, we have oversold conditions in the technicals, and we should get a rebound at least in the overnight futures, if not in the morning session. We'll talk about that a little more in the conclusion of this video because we have an important event tomorrow. But before we do that, let's move on to commodities and look at what happened here. Crude futures went higher for the day, and the reason is the yen went higher. Dollar went down initially, so we're seeing some commodities moving higher, although the dollar closed well above the lows. And that leads us to what I talked about a few days ago when I said, hey, watch out, we're going to see the Fed versus the ECB coming, the currency wars. And this is going to be a race to the bottom, because when the Japanese shore up the yen and push the dollar down, well, guess what happens? Food futures move higher, metals futures move higher, commodities futures move higher in general, of course, and that produces more inflation. And then the Fed has to respond and become even tighter in the monetary policy and raise interest rates by more. The dollar goes higher again, and guess what happens? The yen goes down, the euro goes down, the pound goes down, producing more inflation in those countries. Why? Because let's say the value of the pound goes down. Well, now it takes more to buy any of these futures using the dollar. By that alone, costs and prices go higher. So then what do they have to do? The ECB, the Bank of England have to raise interest rates even higher to push the value of the euro and the British pound higher. And the dollar goes down. But we see commodities in the US dollar moving higher again. Then the Fed has to respond. It goes back and forth, a race to the bottom, which could increase the risk of a recession significantly higher. Now today, crude futures were higher. The WTI, Brent, so was the gasoline, RBOB, so was heating oil. But natural gas was down by about 7% today. And of course, somebody's looking for the arbitrage opportunity. And that somebody is Erdogan of Turkey. He wants to buy US natural gas and then sell it for a higher price for European customers. In other words, we have a floor. We have a put on natural gas prices here in the US. If they get down too much, somebody's going to scoop them to sell them back to the Europeans. What about softs? We have modest gains for OJ, a little over 1.5%. Coffee was up by about 1%. So was sugar, up by about 1%. But look at this, lumber is down big by about 7.25%, followed by cocoa futures down by almost 1.5%, and then modest declines for cotton futures for about 0.5 percentage point. When it comes to metals, mixed picture here. We have platinum down by about 1.25%, but then we have muted reactions from gold and copper, and then we have positive reactions from silver and palladium. The confusion is clear, and the reason is the dollar went down initially, after the yen went higher, but then the US dollar recovered as the US trading in the stock market started. And this is, by the way, a signal of the relative strength of the US dollar. Even with the Bank of Japan, with the SMB, with the Norwegian Bank, with all of these central banks increasing rates higher, the dollar remains resilient. And the dollar is a friend and a foe for both the Fed and market participants. Why? Because a higher dollar keeps a lid on inflation, specifically when it comes to commodities inflation. On the other hand, the higher dollar erodes corporate earnings and it lowers the GDP. So it is a double-edged sword for now. And the evidence is, look at copper. The fundamentals for copper, for example, are still pretty good. The demand is projected to be a lot higher among most countries, and the reason is the demand for EVs. Copper goes in the lithium-ion batteries, the wirings of EVs, etc., etc. The demand is sky high. It will remain high for years to come. So the tailwinds are intact for copper. The tailwinds for natural gas are intact. The tailwinds for crude oil are intact. But we have a massive headwind. That is the rise in the US dollar because the Fed is tightening the monetary policy. And the dynamic for now is the headwinds are much stronger, are more powerful than the tailwinds. But the moment the Fed eases and the value of the dollar goes down, we will see all of these commodities shooting up higher because the tailwinds remain intact. In other words, the Fed right now cannot afford to take their foot off the pedal, the tightening, whatever you want to call it, doesn't matter to me. But they cannot pause or pivot or even cut rates at this point because the moment the dollar goes down, all of these commodities will explode higher, causing more and more inflation. Anyhow, what about meats? Down across the board, feeder cattle, live cattle, lean hogs, all down. When it comes to grains, we have modest gains for soybean oil, about 2% along with canola futures, and then about 0.5 percentage point worth of gains for wheat. Corn was flat, pretty much beating the green. And then we have losses led by soybean meal, followed by rough rice, oats, and soybeans futures. Moving on to the big casino, the options market. What's going on here? The volume remains, I would say, below average, but it is moving higher in certain names, specifically Tesla, aka the souffle, came up number 1. Around 2.5 million contracts traded today. About 51% of those were calls. And at number 2, Apple. We'll talk about Tesla more, by the way, in a second, because we have a short gamut today. But anyways, Apple at number 2. At around 1.7 million contracts traded today. Once again, more puts than calls. This time around, about 54% of those were calls. Apple is going to go down, no doubt about it. At number 3, Amazon, with around 850,000 contracts traded today. About 50% of those were calls. Now let's talk about Tesla here. These are the calls with the expiration expiration date of tomorrow. Now, when we look for a gamma squeeze, we look for a sudden surge in the volume for out-of-the-money calls or puts. The higher the volume, the stronger the gravity. If the calls outnumber the puts, we have a gamma squeeze. To the upside, of course, the traditional gamma squeeze. But if the puts outnumber the calls, and they happen to be closer to the money, meaning where the stock is trading at the moment, then they have a stronger force of gravity. But we see a short gamma. We see the stock getting pulled significantly to the downside. Well, let's see what happened today. The calls for tomorrow's expiration, for the 290 calls, we got about 88,000 contracts traded for the day. Now, this is the closest contract to the money at the closing. Yet the closest contract when Tesla was trading in the morning was the 295 calls. Well, we got about 113,000 contracts traded for that one. Now, let's contrast this with the puts, and as you can see, the 290 puts, the volume outnumbered the 295 calls. In this case, over 166,000 contracts traded for the 290 puts. In other words, the force of gravity was to the downside. Buyers of puts outnumbered buyers of calls, and therefore we got a short gamma to the downside. And this will likely continue in tomorrow's session, and the reason is, look at the next put closer to the money right now. It is the 285, and the volume was over 104,000 contracts for that one. On the other hand, the closest call to the money right now, the 290, did about 88,500 contracts today. So once again, buyers of puts outnumbering buyers of calls, and this will move the stock to the downside. Now, what about the unusual activities that took place in the options market today? We start with the ticker VJK, and this is for the European ETF. Somebody sees more downside coming, and they did a put spread. They bought the 46 puts and sold the 42, all for the expiration date of November 18th. With expectations that the VJK could go down by more than 5% by then, but not more than 13%. They paid around $1.25 a piece for buying the 46 puts, and they received about half a buck a piece from selling the 42 puts. All in all, the entry cost is reduced to about 75 cents a piece, bringing the total to about $2 million. And then what about the ticker IYR? This is for the real estate ETF. Somebody sees upside coming, meaning yields will go down. And they did so by buying a call spread. They bought the 94 calls and they sold the 98, all for the expiration date, December 16th. With expectations, the IYR could move higher and gain more than 8% by then, but not more than 13%. They paid around $1.25 a piece for buying the 94 calls. They received in credit about 55 cents a piece from selling the 98 calls. All in all, the entry cost is reduced to about 70 cents a piece. That brings the total to about $1.3 million. And then we have the trade for the ticker ARKKKK, Tesla witch Kathy Wood. Somebody sees more downside this time around. They bought the 35 puts for the expiration date, November 18th. With expectations that the name could go down and lose more than 9% of its value by then. They paid around $2.30 a piece to enter this trade, all in all spending around $3 million. What about the ticker UPS? For, you guessed it, UPS. FedEx went down big, along with it UPS. Somebody thinks that this is an over-punishment for UPS, and FedEx has its own problems. So they see more upside here, a rebound for UPS. They bought the 182.5 calls for the expiration date, October 21st. With expectations that UPS could rebound and score gains of over 9% by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. And then what about the XLK, the technology ETF? Somebody sees more downside coming. They bought the 105 puts for the expiration date, November 18th, with expectations the XLK could go down and lose more than 16% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. And lastly, at the bottom of the table, what about the ticker SPY, the S&P 500? Somebody's hedging or making a downside bet, a bearish bet, by buying the 348 puts for the expiration date, November 18th, with expectations that the name could go down and lose more than 7% of its value by then. They paid around $6 a piece to enter this trade, all in all spending around $3 million. Moving on to the heat map, what's going on here? Mostly a bloodbath across the board with few exceptions. In technology, we have Microsoft. It outperformed today along with CRM, Salesforce. We know Microsoft was the underperformer in big caps as of late, so perhaps we're seeing some short covering here. Salesforce, on the other hand, came out with a rosy outlook for 20.
Enemy kill. Double kill. An enemy has been slain. Shut down. Double kill. kill. Your team has destroyed a turret. destroyed. Your turret has been destroyed. Minions have spawned. An ally has been slain. Shut down. An ally has been slain. Your team has destroyed a turret. Killing spree.